Welcome back to Investing Talk Podcast.
Today, we're looking at BlackRock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it. When you talk about BlackRock, the first thing that always comes to mind is just the scale. It's almost hard to wrap your head around.
It really is. And the Q3 2025 numbers, they really put that on full display. This is a company that's already the biggest in the world at what it does, and it's still finding ways to accelerate.
Absolutely. The big headline number is the assets under management, or AUM. It hit a record, what was it, around $13.5 trillion?
Roughly, yeah. About 13.5 trillion. And you have to pause on that number,
You really do.
To give you some context, that is more than the GDP of every single country on Earth except for the US and China.
That's just insane. You're talking about the plumbing of the entire global financial system.
And the incredible thing is that growth wasn't just markets going up. The real story here is the inflow of new money. That's what's driving it.
Right. Client conviction.
Exactly. Net inflows for Q3 alone were a staggering $205 billion. That's their best quarter for new money since that big rush back in 2021.
And over the whole year.
Over the last 12 months, clients put in almost $640 billion in net new assets. I mean, that's the engine. It's a platform that's just pulling in a huge share of global capital.
And that asset gathering, it translates directly into financials. The Q3 revenue was $6.51 billion. That's a 25% jump from last year.
Operating income was just as strong, up 23% to $2.6 billion. It really shows that their size is an advantage, not a drag on growth.
And crucially, they beat what Wall Street was expecting.
By a lot. The diluted EPS came in at $11.55. Blew past the consensus estimates. It shows real earnings power.
But what I find even more interesting, for anyone thinking long term, is what management is saying about the future.
Ah, yes. The 5% target.
Exactly. They're targeting more than 5% organic base fee growth all the way out to 2030.
And that term base fee is so important here. Asset managers make money from, well, two main things. You've got the volatile performance fees,
which can be up and down.
right? And then you have the base fee, the steady percentage they charge on all that AUM.
A sticky revenue.
Precisely. And they are promising to grow that reliable, sticky revenue by 5% a year. That really underpins a long-term compounding story, no matter what the markets do in the short term.
Okay, so that brings us to the big question. How? How does a business that so many people see as a commodity, I mean, asset management is all about low fees, right?
Yeah.
How do they keep growing like this? What is their competitive moat?
That is the whole story. And it comes down to two things that work together: scale and software.
Let's start with scale. Being the biggest at $13.5 trillion. But doesn't fee compression make that less important? I mean, can a competitor just come in and offer a cheaper index fund?
It's a fair question, but the scale isn't just about size. It's about the network effect they've built with their iShares ETF business.
Okay.
iShares is the global market leader, and because they're so big, their ETFs are incredibly liquid.
Right, the liquidity flywheel effect.
Exactly. For a huge pension fund or an insurance company that needs to move billions of dollars, that liquidity is everything. It means they can get in and out with tiny transaction costs and without moving the market.
And a smaller competitor just can't replicate that.
It's almost impossible. That liquidity, plus just the sheer number of products they offer, it creates really high switching costs. Once an institution builds its whole system around using iShares, pulling it all out is a massive, expensive headache.
So the scale kind of locks clients in. But you said that's only half of it. The other half, the software. This is where it gets really interesting. Aladdin.
Aladdin is, I would argue, their most important asset for the long term. It's their proprietary risk management platform. And you have to think of it not as a product, but as the central nervous system for a huge chunk of global finance.
So break that down for us. What does it actually do?
Imagine you're a giant pension fund.
Yeah.
You have assets all over the world, stocks, bonds, real estate, everything. You need to know instantly what your total risk exposure is. Aladdin does that. It pulls all the data together and gives you one unified view of your risk.
And it's not just BlackRock using it. They sell it to other firms, even competitors.
Correct. And by getting Aladdin's software embedded deep inside their clients' operations, it makes those clients incredibly sticky.
It's like trying to rip out the core operating system of your company.
You got it.
Yeah.
It's just too complex and too costly to switch. So it creates this high margin recurring revenue that looks a lot more like a tech company than a finance company. They're basically selling the plumbing.
And speaking of strategy, they're not just sitting on their laurels with passive funds. They are pushing hard into alternatives.
Absolutely. They know that while ETFs provide the scale, the really high margin growth is somewhere else. So they're using their financial muscle to buy their way into those areas.
We've seen that with the big acquisitions, GIP Global Infrastructure Partners and HPS for private credit.
These were brilliant moves. GIP gives them these long-term, stable assets like airports and toll roads, things that do well even if the stock market is shaky.
It's a hedge, less correlated to the public markets,
Yeah.
and it's inflation resistant.
Exactly. And the HPS deal for private credit, that taps into this massive demand from institutions for yield, for returns that you just can't get from normal bonds anymore. They're becoming a one-stop shop.
This expansion makes you wonder what's next. We've heard some chatter in the market about them maybe doing even more acquisitions in that space.
That's right. When you're their size, pretty much any private asset firm could be a target. But the really forward-looking stuff, that's in digital assets.
The crypto angle.
Sort of. More about the infrastructure, things like the tokenization of ETFs. It's still speculative. It's not a core driver today. But if that's the future, they are positioning themselves to be right at the center of it.
Okay, so scale, sticky tech, smart acquisitions. What about the foundation? How solid is the balance sheet that's supporting all this?
It's very, very solid. They're managing it conservatively. Their debt-to-equity ratio is low, around 0.34. That means they have a ton of flexibility to keep making these moves without taking on too much risk.
And liquidity.
Fantastic. Their current ratio is about 4.4, which for you listening just means they have more than 4 times the cash and liquid assets needed to cover their short-term bills. It's very strong.
And this all translates into shareholder returns. They've grown their dividend for what, 23 years straight?
23 consecutive years. That's a huge signal of durable cash flow. And they're buying back stock, too. About $375 million worth in Q3.
Which just boosts the earnings per share for everyone who holds the stock.
Exactly. And you see that confidence from the big players, too. We saw that CalPERS, the giant California pension fund, recently bought another 19,000 shares or so.
When a fund that big is buying, it's not a short-term trade, it's a statement.
It's an endorsement. They see it as a core holding for the next decade or more.
Okay, we have to flip the coin, though. The bear case. What are the headwinds? What could slow this machine down?
The biggest one is always going to be fee compression. That race to the bottom in the ETF world never stops. It puts constant pressure on how much they can make per dollar of assets.
And the Q3 report did flag something on costs.
Right.
It looked a little worrying at first glance. Expenses were up 26%.
They were, and it dragged the reported operating margin down a bit to about 44.6%. On the surface, it looks like costs are getting out of control.
But there's a catch.
There's always a catch. That's the reported number. And it includes a lot of noise from performance fees and, critically, the one-time costs of integrating those huge GIP and HPS acquisitions.
So if you strip that noise out,
if you look at the adjusted margin, it actually went up. It expanded to 46.3%.
that's a huge difference. So the underlying business is actually becoming more profitable.
That's right. The core operating leverage is still there. They're spending money to grow, yes, but the core engine is getting more efficient.
But there are still the macro risks. Their business is tied to the markets. If we get a big crash,
They'll get hit. There's no way around it. And the other thing is just political scrutiny. When you manage $13.5 trillion, you're always going to be in the crosshairs of regulators and politicians, especially on topics like ESG. It's just a cost of being that big.
so let's look ahead. What are the next big things on the calendar for them?
The next major event is the Q4 earnings release. That'll be around mid-January 2026. Analysts are expecting another strong quarter, with EPS around $13.53.
And everyone will be listening for updates on that 5% base fee growth target and how the integrations are going.
Absolutely. And the broader environment seems pretty good for them right now. If we get interest rate cuts or even just stabilization, that's usually good for stocks and bonds.
Which means more flows into their ETFs.
Exactly. And the big long-term shifts, more money going into passive investing, more institutions wanting private credit and infrastructure, those are all massive tailwinds that play right into their strategy.
So when you pull it all together, what's the picture that emerges?
You have a company that is just executing on all fronts. You have the iShares business providing that unbeatable scale. You have Aladdin providing the sticky, high-margin software. And now you have this alternatives business providing a whole new engine for growth.
That's not just a simple asset manager anymore.
Not at all. For a long-term investor, you have to look at this as a multi-year story, maybe 3, 5 years, or even longer. It's a way to play these huge global shifts into indexing and private assets.
A true compounding machine. But I'll leave you with one final thought to chew on. If their biggest risk is a market downturn, and their big strategic move is to buy assets like infrastructure that are stable during a downturn, what does that tell you about what the smartest people in finance expect from the public markets over the next 10 years?
A very interesting question. It suggests they're preparing for a different kind of world.
Something to think about. And for all of you listening, remember to subscribe for continued analysis and join us next time.